Joining me now live in our Lagos studio to assess new projections ahead of Monday's MPC meeting, I have Chief Investment Officer, Afri-Invest Asset Management Limited, Robert Omotunde. Good to have you on the show today.
Thank you.
Now,
my pleasure.
Let's talk about the breakdown of figures we had at the last Monetary Policy Committee meeting in November. It came as no surprise when the NPR was retained at 11.5%. But now that we are dealing with stronger inflationary pressures, we are looking at the country in recession and much more. We have quite a limited growth trajectory. What new twist do you expect might come into bear with this next meeting on Monday?
It's a tough one for the Monetary Policy Authority. And on Monday and Tuesday, the MPC will be deliberating on taking very tough decisions. You know, as you rolled out, since the last MPC meeting in November, we confirmed already at the meeting that we slipped into a recession, which is the second we're having in about 4 or 5 years. And then again, we've seen significant pressures on domestic price levels. Inflation is currently reading 15.75%, and growth numbers are not looking so good as well. The economy is still struggling to recover. In economies all over the world, governments are talking about putting in more stimulus to boost economic activities. But in our case, we've seen some stimulus coming from the central bank. On the flip side, the government is limited because of the revenue fundamentals of government, which is also not strong. Government itself has had to be approaching the local debt market to fill in the gap, part of which central bank has also been providing support for through ways and means. So in this next meeting, the reason why I said it's tough is because, number one, you're seeing a situation where inflation is rising. So theoretically, someone would think that to curb inflation, what you have to do is to raise interest rates. But that is when the mechanism is effective between the monetary policy rate and the market rates. In our case, what we've seen, we've said it severally that even NPR has lost is beginning to lose its relevance because at 11.5% NPR, throughout last year, even when rates picked up last year, we still saw that market rate yields on the longest, bonds in Nigeria, for instance, closed last year at about 7.8%. Meanwhile, NPR is at 11.5%. As we speak, the longest yield is still, around 9%.
Well, look at that.
If you even talk about the money market rates, they are even much more lower. So in the real sense of it, there is no real positive real return. So the other argument that most people have made will be government needs to guarantee real return within the economy. But the point I always like to say is that the world over, most developed countries of the world, we don't find positive real return, even before the pandemic. As we speak today, U.S. inflation is averaging around 1.2%. Treasury yield is closer to 0%. So there's negative real return all over the world. So, the decision to raise or not raise will not be based on whether government wants to achieve real return or not. And as we have said, there is no potency or no effectiveness in transmitting what happens at the monetary policy level to the market rate. So I do not think that it will make sense for the Monetary Policy Committee to raise NPR at the next meeting for inflation argument. Again, because our inflation is largely cost push than demand pull.
Now, the last meeting as well, we had the central bank governor also reiterate the 3 stances we have. It's either to tighten, loosen, or maintain the parameters and like. But now let's bring to bear 2 economies, the American economy and then Nigerian economy. We just had the inauguration of Joe Biden as well. He's going to acquire a bullish stock market. The market has traded quite well all of this period so far under the Trump administration. But now they have to deal with weaker dollar.
Absolutely.
They also have to deal with tons of debt. Nigeria has ballooning debt levels at this point in time. The Naira is not necessarily trading at a fair enough situation, but we still have the population, we still have the numbers. Now, going by the loan-to-deposit ratio that we've had. We've seen non-performing loans have also still within the 6-7% threshold. We are making some gains in some front, but it's not the best picture. How do we now begin to navigate through all of these market fundamentals that we have to deal with, especially at a time that we're dealing with a recession and then hit by the second wave of the COVID-19, God forbid, as so many would say, a third wave comes and then we are stifled much more?
I think that we have to choose our battle, right? So, I mean, it's not news that we have several macroeconomic headwinds,
not at all,
staring us, several macroeconomic headwinds. So, and the government or policymakers cannot address them at all times. Because while you think you're trying to solve a problem, you'll be creating another. I'll give you an instance. If the MPC says next week and say, they want to tackle inflation, and so what they want to do is to raise the price of credit, so increase NPR so that cost of borrowing can go higher. Who suffers it? We are still talking about economic activities that are very, we are at a very weak level right now. So if you raise the cost of borrowing, even though it's not so effective, but for whatever it is worth, the impact on the economy will still be to, slow down economic activities. So what do we want to do? Do we want to stabilize prices or do we want to boost economic activities? Those are decisions that we now have to take. But if you ask me, I would say, as far as economic activities are concerned, what we have right now is, some of the things that we brought upon ourselves. Again, COVID-19 did not help because COVID-19 struck and then a lot of
prices, external reserves
of livelihoods were affected. External reserves was depleting. And then what we saw was that the central bank started rationing the dollars. So all of those exchange rate sensitive goods that we import from outside the country, prices went up. And the domestic prices too were not stable. So people had two issues to deal with. They don't have money, and now there is elevated price level. So even the little you have to pay a lot of that to be able to get little few goods that are available. So it's a compendium of issues, that an average individual will have to deal with. That's why I said the government will have to choose this battle. What is most critical right now, in my view, is to do whatever is within our power to stem the tide of this high level of inflation that we're seeing. It is not sustainable. It will put more people into poverty. We can...
But there are forecasts that will still even surpass this 15% threshold we're in,
the likelihood
to 16-17%.
This first quarter
will be tough.
We might still have higher level of inflation, but it will begin to moderate again because that part of the reasons why we have 15.75 inflation right now is because there was border closure in 2019. It slipped into 2020, and now border has been reopened. At least as announced by the government. Now we had increases in pump price of petrol last year. That is not likely going to be cheering news because we may still see more of that coming, especially because we've seen
reflecting the price of oil recovery
in global oil prices. Electricity tariff was also a factor, that may still continue to play out in 2020, 21 as well. But the good thing is that border is reopened. So, goods can move around and we can begin to see some moderation in prices. But the best forecast for 2021 will still tell you that we see inflation at a double-digit level. So it's not good news for us, But what the government can do is, look at border closure, for example. It was an ill-advised policy, if I'm to analyze it. Because again, you don't shut the border when you have not provided alternative. We have shortages in local production and then you don't shut the border. And now we have realized, just after a year that we made the wrong decision, but the damage is done already.
Whether or not we are making the wrong or right decision now, we also look at the stance of the CBN. For so many economic watchers, they say the injection of liquidity into the market is not necessarily sustainable as well in the long term. We also look at the fact that Fitch Ratings as well has raised some new cautions in terms of our domestic debt level as well. Just barely a few hours ago. How do we now begin to expand credit when we have this current crunch? And then Fitch Ratings, once again, we had the instability in the market where at a point in time, the banks were trading favorably with the ratings from stable to unstable and then stable back again.
I mean,
it's a lot to deal with.
It's a lot to deal with, and I think what Moody's, Fitch, and S&P, all of them are bothered about right now, from the sovereign perspective, like you said, is the ballooning debt level. But one thing is also to disaggregate our, debt stock, and to say, okay, what proportion is, local, what proportion is external. You will find out that we still have, huge chunk of our debt in local currency. So to that extent, there is a limited risk when you look at defaults.
But do you think we're just turning a blind eye to a ticking time bomb? Because we are having cautions time after time, quarter after quarter, but we all play conservative in the area of saying, well, we are not at the limit of over 50%.
Yeah. The way I like to look at debt is to say, compare us to other countries, similar countries, even if you don't want to do developed countries of the world. In terms of the size of debt, we don't have a major issue. The problem we have is the servicing of those debts. So, and that is where government needs to address the nature of budget that comes out. I think that government is not being conservative in terms of budget preparation, because I believe that the revenue fundamentals of government as it is right now, if we are conscious about reducing our debt stock, should not be at the size that it is right now. But again, government always believes that when we have major economic crisis, such as we are having with COVID-19, they have to throw money at it. Do you understand? So, but again, sometimes the spending that you need to get out of the problem may not necessarily have to come from government, especially on the fiscal side. On the monetary side, we can make argument that, okay, it's part of stimulating economic activities, so central bank can print money to do that. That's what we see happening in most developed economies, where the US Fed, for example, if you compare,
rates and also,
yes, they cut rate and then they throw some money, asset purchases, quantitative easing, as we say it. These are, things that are done by simply just printing money. So, but the issue is, on our side, we see the fiscal authority trying to do so much. But sometimes it's even better if you allow the monetary authority to do that, since they have mandate for stabilizing prices, maintaining growth. Sometimes when they print money, it doesn't, create as much issue as when the fiscal guys are the ones asking central bank to print money. As we have right now, Ways and Means, which is a way of government, asking the central bank to support the budget, has hit about 10 trillion in only about 3 years. And these are some of the issues that Fitch, for example, mentioned in the latest report that came out, I think about 2 weeks ago. So for us to continue to monitor the level of debt that we have, now we're talking about securitizing some of those monetary, financing stock that we already have, which has hit 3 trillion. But can the market accommodate the huge size that we already have outstanding right now? The answer is no. So again, to monitor our debt means that prudence is needed. Fiscal consolidation is not what we have had incremental budgeting since 2015, even when our revenue fundamentals are shrinking. Maybe it's not the best way to go. Rather than make policies that can, open up sectors and put in more money in the system, we keep on increasing the size of our budget, and we do not have the revenue to support it. Hence, our debt profile keeps rising.
Let's take a look at the moves now by the European Central Bank and other central banks across the globe. It's cutting interest rates to 0%. Do you think we can replicate such working models here in Nigeria? Let's also look at intervention funds as well. We've had the CBN also tried to churn out about 5 billion naira, some say better late than never, to the aviation sector. We look at agriculture, we've had some stimulus there to catalyze or spur growth. A couple of millions of naira, 100 million thereabout. But these are still just very little or meager funds that cannot even solve the issue of the day. Aviation, well over 20 billion naira in debt and a whole lot more. The agricultural sector, we are saying we have to make it the mainstay of the economy. We have to feed the people. We have to do much better. But these sizes of intervention are nothing compared to what we have on the international front.
Exactly. So, I mean, if you look at the size of intervention funds we've seen since COVID-19 for Nigeria, think our level is around 3%. Compare us with even some countries in Africa that are within the double digit. So again, the government is limited in capacity based on its revenue sources to be able to put out most of those stimulus. So if you see the government rolling out more stimuli, it means that the government is possibly turning to the central bank to print more money. You understand? So capacity of government to continue to do that, in my view, is currently limited. But in terms of whether there could be effectiveness in reducing, interest rates and see it transmit into the economy, we have a challenge in this part of the world. I'm one of those that argue that today, there's an MPC meeting on Monday. If by Tuesday CBN announces that MPR has been cut to 5%, you won't necessarily see lending rates, especially to the retail customers, reduce that same magnitude. Why? Because there are so many risk factors that banks are looking at. And the price of credit, it's a combination of several risk factors that the banks are pricing. So before they will tell you an interest rate is 20%, it's because they think there are certain risk factors that are attached to it, and demand and supply as well. So, and how many people can afford to continue to borrow at that level of interest rate? And even if you reduce the interest rate, it's not necessarily going to come down at the market level. So what do we need to do? De-risking the economy, de-risking our business environment, and de-risking specific sectors that we know can catalyze growth is the area that I think government can intervene. And the banks can't do it themselves, unfortunately. So they need the government. That's why they are paying taxes. So if the government would not do it, we still talk about insecurity all over the place. So if a banker is in a place like Borno, and you want to lend money to a farmer, you better think twice, because your money will just be gone down the drain due to insecurity. So these are all issues that a lot of banks are dealing with today. Maximum loan to deposit ratio is 65%. But when you analyze the books of the banks, in the tier 1 space, only a single bank is maintaining that threshold, Zenith Bank. Within the tier 2 space, maybe about two banks or more, Fidelity Bank and Sterling Bank. The rest of the other banks are below the threshold that the central bank has set. Why? Because most of them will rather keep the money than lose it. When you lend out and you cannot recover, you've lost the money.
Did it come to you as a surprise?
These are some of the issues. Yeah.
Did it come to you as a surprise? Within the second half of last year, we saw loan-to-deposit ratio still pegged around the same level we had within the first half of the year.
Yes.
We had the hit of the COVID-19, the first wave. We also had the aftermath of protest as well. Yeah. People were still paying back their loans, and it was quite a surprise. How can people still maintain that credibility or responsibility to pay back, irrespective of the call for breaks or extension of period to repay loans?
Again, you see, some of the issues we need to look at is when you dissect the loan book of the banks, what is the proportion of,
I make mention of this because this is one of the highlights of the CBN's meeting as well. It prides itself in the fact that we have quite a low rate of loan-to-deposit ratio.
Absolutely. We have it because...
Non-performing loans, I beg your pardon.
Yes, we have it because some of the banks think that the sectors or individuals who lend to, or sectors are very risky at this time. And if they consider the sectors to be very risky, some of them wants to take, toe the path of caution, rather than to be sorry.
Play it safe.
Just stay safe. We're still talking about the MPL that we are beginning to see a bit of elevated levels for non-performing loans. So the same central bank that will say, guys, create more loans, is the same bank that will come to you and say, you're already breaching your threshold for non-performing loan. So it's a difficult and a tough business environment for most of the banks, especially, So, and again, like I said, it's not something that the banks can do alone. The government has to come into the space and ensure that the business environment is ideal for creating most of these, risk assets that we really need for us to stimulate economic activities within the system.
The bullish trend we saw in the Nigerian market in the year 2020 was a big surprise.
Absolutely.
We've never seen such record highs as we saw last year, but it seems like the government and the economic advisory team are blinded to exploring the capital market in terms of an alternative revenue base. We now see talks around going into the pension funds and a whole lot more. Those are not conversations that we should be looking towards to replicate working models. How do you think we can also now explore aggressively the capital market this time around? Yes, the governor of the Central Bank of Nigeria made mention of all of this, but we don't necessarily see efforts within that regard to smooth in how we borrow.
Yeah, I think that in all honesty, the government has tried a bit in exploring the domestic capital market. Equities market did well, but you know, when the federal government wants to, support its budget, they will do it via debt and not equity.
No,
So they have to approach the local debt market. So in the deficit of about 4.6 trillion that we have for 2021 budget, the government is already suggesting that part of it will be done locally and the rest, internationally. Because again, that offers low yield environment. It comes with, a double benefit. Low yield environment right now because most Eurobond assets for Nigeria are trading at all-time high in the international market. So if we go to the market now, we are borrowing at a lower price. In addition to that, that flow will be an accretion to the reserve to support the vulnerability that we have now in terms of our external sector, at least for the time being. And the government can lengthen the duration of most of the issuances. We've seen in 2018 when government went to the market that we had up to 30-year tenor. Some countries within sub-Saharan Africa are even doing 40-year notes. So the duration is lengthening significantly. You get the short-term dollars, which you desperately need, and then you get to now also borrow at a lower level of yield, which is even better than what you will get in the local market as we speak. You understand? So I believe that government is going to balance both in this 2021 budget, as we said. The Ministry for Finance and the Budget Office hosted a webinar last week where they confirmed that they are most likely going to look to the two, options in funding the 2020-21 budget. So they've done well, practically well. As we speak today, the federal government is still the biggest supplier in the local debt market, and that's why everybody was waiting for bond auction that held yesterday before people will know what direction the yields are going to go in 2021.
Weaker dollar, weaker naira, that's what we are dealing with at this point in time. Cautious optimism is also the word out there. Do you think the conversation of devaluation or not will come again?
Well, I think that to the extent that we are still, vulnerable in terms of our external sector balances, there will always be an argument for adjustment.
You're saying the reserves gradually picking up as all prices are going up?
So if the reserve picks up, that's the basis for valuing it in the real sense of it.
There's a shocker in case if anything happens with COVID-19. Once again, our hopes are on the vaccine.
Well, the way to look at it is that reserve potentially serves as the supply to the market, right? So the demand are different, sectors, different individuals that are competing for the dollar. So if you see a stronger reserves, it's an indication for a fairer valuation of the currency. But to the extent that you now begin to see, maybe slowdown in, commodities prices again, and already we're suffering in terms of our foreign portfolio flows, in terms of foreign direct investment, all of those are slowed significantly. So the major sources that we have now are through remittances and proceeds from oil.
And even for the diaspora remittances, that's also dropped as well.
Yes, it dropped, but I think the policy of government, of the central bank, was helpful, to note that if you send your remittance or your flows through the banks, you can actually get them in dollars, which you can then exchange at a much more competitive exchange rate. But I think the question of devaluation will always come for as long as those fundamentals demand for an adjustment.
For an adjustment indeed, and definitely we'll keep our fingers crossed or not. The MPC is going to decide to retain or not. It's just quite a fit at this point in time, but we just hope to see Nigeria try to maneuver through this current recessionary pressures we are dealing with. We'd like to see our sectors of the economy bounce back. The forecast is that by the second half of the year, we'll see things improve. So let's just hope for the best. Let's be optimistic. Thank you very much for your time on the show today. So far, we've been speaking with Chief Investment Officer, AfriInvest Asset Management Limited, Robert Omotunde. Good afternoon.
Thank you.